We're here at the Milken Conference in Los Angeles. It's where Alec Ellison, the chairman of technology investment banking at Jefferies and Company, moderated a panel on the next big things in high tech. Ellison joins us now to discuss whether the buzz will meet expectations. Alex, good to have you with us.
Thank you very much.
So how would you characterize the current deal-making environment in tech right now? There's a lot of buzz, but are we seeing a lot of action?
I think we are. I think we're seeing a lot of deal making on two levels. One is in the mergers and acquisitions world, where activity has really recovered almost to the types of levels we saw in 2006, 2007. Some of this has really been driven by these massive cash balances on the big titans of the industry, the IBMs and Microsofts and Oracles of the world. On the venture capital front of deal making, the activity is starting to get to frenetic levels. In fact, one of the topics we covered yesterday is, are we entering a new tech bubble? Which I don't think we're there yet, but those of us who were around a decade ago certainly see some similar signals.
And you can understand why, even from a layman's perspective and not an industry outsider, when you look at the valuation that some of these companies are getting before they've come to the public markets, when 5 of the big players have a $70 billion valuation combined. It's a reasonable question. So why don't you think it's a bubble yet, and what are the warning signs that you're looking at?
Well, you never know you're in a bubble until it bursts. That's the aspect of bubbles, is that they are clear. I think we're talking about businesses that have real revenue and real cash flow. You're not hearing about companies being valued based on number of page views or number of visitors. And you're alluding clearly to Facebook. In fact, one of the panelists said, well, Facebook at 50 billion might seem reasonable, but maybe not 85 billion. And audience laughs. Either way, it's a big number. But just as a company that has fundamentally changed how people are interacting.
Changed how they're interacting and has real revenue coming in.
Absolutely, real revenue and real cash flow. It's not just revenue. They're not just generating revenue and saying, okay, we'll make money in the future. They're making money now with very, very strong margins. And fundamentally, one can argue this is a whole new computing platform. It's certainly a new connectivity platform, but the new applications and services and products that are coming on top of it make you wonder, is this really the next computing platform, not just a connectivity platform?
Are the founders of today's most promising tech upstarts, if you will, the Facebooks and the Groupons, different from founders of the previous generation?
Are they different? I think that any of these founders today were old enough, even if they were teenagers 10 years ago, to have had a perspective on that tech bubble, and that they have focused on creating real businesses with revenue and profits right from the start. And that was not the case a decade ago during the last tech bubble.
So their mindset is very much shaped by the bottom line of these companies, as much as they are propelled by the excitement of being upstarts and maybe revolutionizing their industry.
Absolutely, and I think there's even one more key distinction, is that they have not gone and looked for venture capital right from the start. The capital efficiency of starting companies now is fundamentally different than we were seeing 10, 12 years ago during the tech bubble. Companies now, you can get a reasonable website up with $50, $100, maybe $150,000. And then say, okay, is this getting traction? Are we getting traffic? Are people using it? Does this have a future? Very different than the approach a number of years back. And so this capital efficiency...
Where there was a land grab that in essence demanded a lot of capital.
Absolutely, there was, yes. And this is one of the reasons we're seeing these so-called angel investors who will often seed companies with these much smaller amounts and see if they gain traction before the venture capitalists come in. So the ecosystem, if you will, is different than it was a decade or so ago.
Looking ahead to the rest of the year, in the 6 areas that I know that you primarily, 6 tech areas that you primarily invest in, where do you think we'll see the deal making most robust?
Well, on the venture front, the private company world, I think we'll continue to see a lot of excitement around what we call the consumer internet. If you think about what's happened in technology the last several decades, it went from the back office of enterprises to the front office to our homes. Now it's with us everywhere, and the devices we carry around are as powerful as a PC was less than 10 years ago. And so that creates all these new opportunities of new applications, new services, and anything along that value chain may be a very exciting investment. And so this permeation of technology into the consumer world is where the most activity is occurring, much less so than in the traditional enterprise world.
And is that primarily in the early stage investment area, or is that with more more mature companies at different levels of their growth?
It's a great question, and it's actually occurring along the spectrum. Everywhere from call it the angel investing of real startups, venture capitalists getting involved early, but you're also seeing late-stage investors who are providing that new boost of capital. You alluded to Groupon, for example, where hundreds of millions of dollars have come in at the much later stages from the bigger capital pools.
That's great. Alec Ellison, thanks for joining us.
Okay, thank you very much.